Hey, it's Peter with the Kompass Realty Group. The Bank of Canada meets at the end of the month, which means more rate hikes on the go, which means probably a good time to discuss mortgage rates. So rates have actually converged, and that just means your 5-year fixed and your 5-year variable are essentially the same now. The bond market hasn't been moving as fast as an aggressive Bank of Canada, which means your variable rate, that spread between that discount you would get between that and your fixed, has tightened to basically nothing. Looking at the chart, we can see that huge run up. And if we look at just a chart of the spread, it has collapsed to zero pretty quickly. So you can see that graph from Rate Hub disclosing all the big banks, 5-year fixed and 5-year variables. There's almost no discount. So if we look at mortgages at origination, and that's just new mortgages created, we can see 5-year variable, 5-year fixed are actually starting to roll over and lose some popularity. And what is gaining is your shorter term fixed, your 1, 2, and 3 years. Now that's because there's some people who look at a 5-year fixed and say, I may be locking in at near or at the peak of the rate cycle, which again could mean you're going to have higher monthly payments and there's a huge penalty to break. Now then some people will say on a 5-year variable, well, I'm not getting any premium for that risk. They're the same. So I'll just opt in for something fixed short term that I can ride out with some price certainty for the next 1, 2, or 3 years. What's really interesting is that while variable rate mortgages are declining in popularity, they still account for almost half of all originations and have moved up to about 35% of the outstanding share, when just a few years ago, they were at like 18%. Now let's do a quick check-in on the Canadian consumer. If we look at our debt to disposable income ratio and compare it to the US in this chart, we can see Canada's actually come back up to their all-time highs, which is north of 180%. So, and looking at the household effective rate, which is simply an average interest rate that the Canadian consumer has to pay across all of their debt products, it's north of 5% now. That's double from last year. So on all forms of debt, essentially the average consumer is paying double the interest in terms of what they were just 1 year ago. We hope you found the video helpful. If you have more questions on the lending side, we have some great lenders that we can refer to you. And if you're thinking about making a move, find your way home with the Kompass Group.